The US dollar has plunged to levels not seen in 3 years. It's been pressured by President Donald Trump's shifting tariff policies and his public criticism of the Federal Reserve's independence. That has raised questions about the dollar's status as the world's go-to safe haven. So let's break down what is happening and what it means for investors. The dollar has long been seen as one of the safest assets in global markets, alongside gold and US Treasuries. But over the past month, that reputation has started to crack. One way to track the dollar's strength is through the ICE US Dollar Index, or DXY, which measures the greenback against a basket of major currencies like the euro, Japanese yen, and Swiss franc. Since Trump's inauguration in January, the dollar has fallen sharply compared to those other currencies, hitting its lowest level since March 2022. What's unusual is that it's falling alongside stocks. The dollar and US equities typically move in opposite directions, especially when markets are reacting to things like inflation or interest rates. But this time, they are sinking together, which is a sign of broader risk-off sentiment across global financial markets. So what's driving the dollar's decline? First, Trump's aggressive and wide-reaching tariff policies have kicked off a trade war, fueling fears of a potential US recession. Second, Trump, along with his economic advisor Kevin Hassett, has publicly criticized Fed Chair Jerome Powell, even hinting at his removal. That has rattled Wall Street and raised concerns about the Fed's ability to stay independent from political pressure. Not to mention the fact that most investors expect slower economic growth in 2025. A soft labor market, a decline in consumer confidence, and retail spending can all pressure the dollar, as they may signal potential interest rate cuts by the Fed. Now, what does this mean for your portfolio? This table shows assets that tend to perform best when the dollar weakens. In other words, assets that are inversely correlated to the dollar's movements. As you can see, international equities and commodities typically benefit the most from a falling dollar. Among US stocks, materials and industrials tend to be the biggest winners. But the implications go deeper than just stock or commodity prices. A weaker dollar can reshape how investors think about safe assets in general, as it challenges the perception of the greenback as the ultimate haven due to the relative stability of the US government and economy. That being said, even with its recent struggles, the world still leans on the US dollar. There's simply no real replacement yet because of the dollar's central role in global trade and the deep liquidity of US markets. But if investors start losing faith in the dollar, they may pull back from treasuries and large-cap US stocks too, shaking up markets in ways we haven't seen in years.